what is better when trading a credit spread? Is it looking at one strike difference? Is it better to go 2 strikes apart? Is it better to go 5 strikes apart? Or is it better to go 10 strikes apart? Well, the answer is there are 2 answers. Depending on what you're looking for, it means it's going to be better to go 1 strike apart, or it's going to be better to go 10 strikes apart. And we're going to take a look at that right now, and then we'll handle your questions. All right, so let's navigate over to the Power Options suite of tools. I'm going to use that here to illustrate my point. Earlier today in my coaching session, the question did come up regarding credit spreads about what is the better one to use. And for a quick example, we're just going to go into the Custom Spread tab where we can build our spreads on the fly or any other positions. We're just going to use SPY. What I want to do is go at least 14 days out in time so we can get a reasonable price. Now today, SPY closed at around 209.31. The customer in the coaching session we were talking about spreads using the 205 strike, a bull put credit spread using the out of the money 205 strike for the December 4th expiration, which is 14 days away. So let's go ahead and add that in. Take a look at the options here. The 205 strike, small premium, 85 to 87 cents. So let's say we can sell the December 205 put for the midpoint of 86. At the same time, if I just did a 1 strike spread, we'd buy the 204 put, and it looks like we're going to have 71 cents. It's only going to be an 11-cent net credit, actually about 15. So midpoint is 71. Okay, so here would be our bull put spread, 4 points out of the money for a 14-day trade, reasonable net credit of 15 cents, but since we only used the 1-point spread, 205, and bought the 204, we receive a credit of 15 cents. Our maximum risk, the margin requirement, would be the difference in strike prices minus the net credit in most cases. So that'll give us 85 cents. This would be a 17.6% return on our investment. So if I did 10 contracts, I'd have to put up roughly $850, and we take in $150. So we're looking to make a 17.6% return, assuming SPY stays above 205 in the next 14 days. Okay, now let's see here. All right, so now what is the difference between this and a 2-point spread? If I kept the same strike, the 205 strike, and bought the 203 put. Okay, so let's just change this out. We're just going to swap. I'm going to go back to December. Oh, I'm sorry, folks. And let's take the 203. Bid of 55, ask of 58. Let's be nice and say 56 cents, okay, for a midpoint. Probably be 57. Well, let's be honest. Let's use the 57 cents for the net credit. So now we have a 2-point spread, still collecting 86 cents for the 205 that we'd sell. 203 put, we're going to pay 57 cents. So on our 2-point spread, we now receive a net credit of 29 cents, almost double. But our margin requirement goes up double as well. Instead of 85 cents, it's now $1.71. So the percent return is 17%. Okay? So slightly less return percentage-wise, higher net credit, of course, because we're paying less for the further out-of-the-money put, which is 2 strikes away. You can already see the pattern, but let's go ahead and fill it. So if we went 3 strikes out, 205 to 202, same expiration series, of course. Use the midpoint 45 to 48. Well, let's say 47 cents again. Doubt we could get 46, but we might. But we're going to go ahead and say 47 cents. So now we're going to have about a 39-cent net credit. So again, 10 cents higher than what we had before, 39-cent net credit off of a risk of 261, which puts us at 14.9%. This is common. And we could keep doing, let's just go to the 205-200 so you can get a quick gauge of it, but you already see what's happening here. So we've got the 205 entered. My 200 put for December would be 31 to 34 cents again. Let's assume the high side at 33. Not really that great of a break. We'd be hoping for, perhaps. So now a 5-point spread on SPY, get a 53-cent net credit. Off of a risk of 447, we're close to that 10-to-1 risk-reward ratio now. But in this case, we're looking at 11.9% return. Now, a probability question came in not related to this. All 5 of those spreads we just did, the 205, 204, 205, 203, 205, 202, and the 205, 200, all have the same probability because it's all focused on the 205. So which spread is the best? That's something you have to answer for yourself. Remember, here are our numbers, of course. This is the 5-point spread, the 205, 200. Really looking at a 53-cent net credit. Good net credit up front. We've got a 447 risk and 11.9% return. The original one-strike spread, 205 to 204, okay, there we go, was a max risk of 85 cents, a potential return of 15 cents of net credit, which came out to be a 17.6% return for a 14-day trade. Okay, so as you go more strikes apart, you're going to receive a higher net credit but a lower return. And of course your risk is going to get higher. The monetary risk is higher as well. Taking a lower strike difference, a one-strike difference, much lower net credit, much lower risk, higher percentage return. So if your focus for your account is on receiving a higher net credit based on the moneyness you want to put into the position, you may be looking here at a wider spread to see a higher net credit up front. If you're more focused on the percentage return of your investment, which maybe most of us are, you're going to be looking at the smaller strike spread difference. Okay? Now let's say that starting from scratch here, we know that we don't normally decide after the fact how much premium or how much margin requirement we're going to put up for a position. I see this at 447 and say, okay, I might put $1,000 into it, which means I could do 2 contracts. We've probably already decided that we're doing $1,000 into a spread or $2,000 to allocate to a spread, maybe even $2,500. So now the question comes in. Let's say we were going to allocate $2,000 to the position. If we're entering the single strike spread at 85 cents, okay, so that would be roughly an $85 margin per contract. If we divide, of course, 2,000 by 85, we see that we could potentially enter about 24 contracts. It'd really be about 23, it's 23 and a half, but we could allocate about, let's just call it 23 contracts if we allocated $2,000 to the 1-point spread. Well, then the total monetary value we take in would be 15 cents times 23, number of contracts, times 100, which would be $345. So 23 contracts, the 1-point spread would be $345 divided by close to the 2,000, okay? So it'd still be the 17.6% return. Now, on the 5-point spread, if we were allocating $2,000, we can see it right here. We're only going to be able to potentially allocate 4 contracts, and not quite 5. So we're going to be able to do 4 contracts here. So we take 4 contracts times the 53 cents. We know that's going to put us at $212. So what's interesting is when you actually factor in the money you're going to invest in the position, even though the wider spread shows a higher net credit, based on the money you're going to allocate, you may be getting more money here. We know that by definition because that's what the percent return is, okay? And that's what it's telling you, is that if you're focused on the percent return, you'll be going with a smaller strike difference. Of course, if you're looking for the higher upfront net credit because you just plan on doing 1 or 2 contracts regardless of what the monetary amount is, which most of us probably don't do, but some of you might, that you've decided that you only want to trade a few contracts at a time when you open a spread position, you're focusing on the wider range. Now, all that being said, and I just want to move on now so I can get to your questions, where I ended the coaching session today is that based on that value, if you do have a security and you're looking at weekly options, and most of the securities that offer weekly options have these dollar strike differences, my personal preference per trade is to go with a 2-point spread. I have no statistics that shows this is better or worse, but I prefer to do 2-point spreads. Let's see, put that in there at 57, we said. Sorry, buy 1 contract at 57. It's still a good return, You know, we were looking at a 17% potential return if I like the probability, and David, you know, I'll get to your question about probability in a second. But the reason why I prefer to do a 2-point spread, if dollar strike differences are available, is number one, we talked about getting the better percent return. But number two is that if SPY does the opposite of what I want, this is a 14-day trade, remember. If in the next 6 or 7 days the stock drops down as maybe trading at 205.50, for example, or 205.75, I may have to consider rolling my position in one way or the other, some adjustment to give me a little bit more safety if I think the stock's going to fall, if I just want a little bit more cushion. The reason why I like to use a 2-point spread is one of the management techniques that might be possible in this scenario is that I could simply buy to close the 205 put for whatever it's trading at that time, and then I could simply sell the 204 put if it still gives me a reasonable profit, but another little point or so of protection if I think the stock might continue to fall, may eventually pull back, or may stay right around 205. Now I've seen the market a little bit more. So most likely this would lower my return from 17%, but I can still keep a bear call spread by just adjusting, I'm sorry, a bull put spread, my apologies, a bull put spread by just adjusting one option and having a roll commission instead of moving the whole spread down and out, which would be 2 or 3 commissions depending on how your broker charges it. So again, having the 2-point spread allows me that if a situation arises, one of the techniques I have available, I might not do it because the numbers might not match what I want to see, but I have the opportunity at least to buy to close the 205 and just move it down one strike, and I leave the 203 in place. Now, yes, at that point I would have a 1-point spread, and if it continued to fall, I'd have to look at a different management technique. But in this case, I have that range between, I have a strike availability between to help adjust the position if necessary. Okay? Excuse me, those are just my thoughts there. Jim asks, are you going to discuss support and resistance to select the right put to sell? No, I'm not, Jim. This was just the beginning part of the presentation. I wanted to spend 5-10 minutes just to discuss the thoughts on the strike difference related to that as well. To tell you the truth, I know what support and resistance are. I don't really look at them on a graph, okay? This is more related to the previous question that came in, Jim, from David. David says, the probability numbers shown in your screen really indicate the actual chance of being filled. Let me take David's question first and then see if I'll get to yours right away. David's question is about the probability. And what does he mean by probability? Let's go to the option chain here for SPY. I want something smaller. I'll take CalMaine for right now. And I just want to look at the call chain. And I'll go to December. Yeah, we'll leave it at medium. But I just want to look at the standard December expiration for CalMaine. And what we're referring to is the theoretical probability above. Okay? And the theoretical probability, so we see here CalMaine closed today at 56.77. As we go to the 60 strike call, slightly out of the money for December, 28 days away, excuse me. The theoretical probability that the stock will be trading at or above $60 is a mere 30.2%. Now, of course, the probability increases as we go deeper in the money, meaning that if I sold the 50 call, which is set almost 7 points in the money, there's a higher theoretical probability in the next 28 days that the stock will remain at or above 50. In this case, actually, it's 88.2% likelihood the stock will remain above 50. I've been trading CalMaine for roughly 5 months, I think. It was 120, 130 days, roughly. It was a radioactive trade I had that I just closed today. I don't think I recall it dropping below 50 during that entire time I was in the position. My original call spaces was 53. It went up as high as 65, came back down to 51 at one point, but I don't recall it dropping below 50. So in the past 5 months, it's never gone below that line. Makes a lot of sense that the 47.50 is at 95.2, and then we go 98 and so forth. So to answer your question, the theoretical probability is essentially based on the past 52-week trading range of the stock. And what we can do looking at those values is apply one standard deviation to get a bell curve for the price distribution. And of course, with the bell curve, you can now say, what is the theoretical probability that the stock will be trading at or above or at or below a given strike price? So here's our in the money range. It's actually kind of a skewed bell curve. But over here is out of the money. So this is more 0, this is 100, and then of course up here you're at the money in a sense. Okay, every stock's a little bit different, but based on the movement of the stock, in this case, you know, we go all the way up to about 57.5, so the skew would probably start here. This would be about the 55, so it'd be a little bit different of a pronounced bell curve here, and then here would be our 60. Okay, so that's how it's calculated, and that's common. Okay, the same way that your brokerage house or other options tools you may be using, they're probably using the exact same calculation to calculate their probabilities. The only thing that changes is the day time frame of the volatility they use in that equation to determine the range. Now, here at Power Options, we do take a look at the forward-looking implied volatility. What's called the SIV, the average implied volatility of the near-term calls and puts, to allow that to factor into the equation based on if the near-term options have an inflated IV or a deflated IV compared to the historical volatility. So we add that in to give us a little bit better view. David's real question, of course, is it showing, indicate the actual chance of being filled? Not being filled at the prices, but being assigned at expiration. So here with our 50 call, if I bought Cal-Maine right now, and I sold my 50 call for midpoint prices, of course, and get a little bit better, there'd be an 88.2% chance that the stock would remain above 50. We'd get assigned and earn that return. David's follow-up regarding the, I apologize, the other comment there was regards to he mostly sells naked puts. Well, in this case, the theoretical probability above, if we sold the 50 put, would be about 11.8%. I'm sorry, the theoretical probability below. We'd still have an 88.2% probability that Cal-Maine would remain above 50. So in regards to support and resistance, the comment that came up earlier, are we going to talk about how we would use support and resistance to pick the strike price? No. But let me show you why. If I'm going to open a naked put today, okay, if I was looking to sell a naked put for the opportunity to get in a stock at a discount or maybe hoping even it expired worthless, for example, I'd go into the search. And I don't know if I have here's some of the defaults that you can use as a stepping stone. I'm going to pull up this one from August 20th. This default search we created on the webinar portfolio for August 20th, and see what we've got here. December standard expiration, minimum naked yield of 1%, out of the money range greater than 1, minimum premium 50, 65% probability above. It might go a little bit higher depending on what I'm looking to accomplish. Good option volume. Stock trades on average 750,000 shares per day, stock above the SMA 50, and then price is based on being a cash secured put, only looking at stocks between 5 and 85, avoiding anything that has an earnings between now and December expiration, mid to large cap stocks, the market capitalization, and good earnings per share. Okay, I might increase the probability here actually from this search. I'm going to go up to about 70 as a starting point. In my credit spreads, bull, put, and bear calls, I'm probably looking at a 70 or 75% probability. Now, with that screen I just created, David, well, I didn't create, but we created in a previous webinar and we were discussing naked puts. I've narrowed down the entire universe of options, all 4,500 or so stocks, indexes, and ETFs that offer options. We've narrowed it down to only 14 results for the standard December expiration that match that criteria. Now, the first one, let's just take Viacom Class B, stocks at 52.71, looking to sell the December 50 put for a bid of 90. So 1.8% yield is what I should expect, and I've got a 72% theoretical probability that it will remain above. Let me go to big charts here. There we go. Okay, sorry, folks. And I'm going to clean this up a little bit. I'm going to go to just the 6-month chart. Looks like I had a disastrous earnings or something recently. Let's see, so let's just go 20. I'm just going to put some Bollinger Bands and things in here. So SMA 20. Let's take a look at the MACD, volume, RSI. You can customize this really any way you want to. Okay. Well, to tell you the truth, I'll be a little bit nervous about this one. What I like about Viacom is the MACD is raising. Remember our target point. The stock's at 52.71. We're selling a low volatility 50 strike put here. There it is. There's our line. It's the 50 strike put. Hasn't been above it much. It's moved below. To answer your question, David, if I'm looking at this chart and I'm dead set that I have to sell a put on Viacom for whatever reason, I am probably taking the 45. I'm not looking at the 50, but there's so much small premium in the 45, it didn't even come up in my search that matched my criteria. Okay, so I don't see Viacom here with the 45 strike. So if I was looking for a new position, I use the search tool to identify what I want. This one came up with a decent premium, a decent return for the volatility right now for the naked yield. But to tell you the truth, I didn't like that chart. It didn't give me a lot of confidence as far as the support and resistance goes to open the 50 put. So I'm just going to move on to the next one. I look at Alibaba with the 75 put and then so on down the line. So that's, again, how I use it. Knowing what strike price I'm going to select, along the lines of support and resistance, I'm more using the search to look for new positions rather than having my mindset that I have to open a naked put on one position. But again, if I looked at this chart, I probably wouldn't be comfortable selling the 50. Now, I could be proven wrong in 28 days. Someone mark that down and check me about it in 28 days, see if Viacom did stay above 50, and this would have been a successful trade. However, just based on the chart and where it's been over the last 2 months even, I'd only probably be comfortable with a 45, and that might even be a hesitation for me as well. But it all comes down to the individual and how you like to look at the positions there to help you determine which strike to select. That's how I would use it, but I use more of just a gauge of that. But usually when I open a search, instead of support and resistance, I'm using probability. As I mentioned with the bull puts, I'm okay to get a lower premium because I'm not doing a cash secured put. I don't think I'd get a good premium I want for December, but on Viacom, if I sold the 45 put for, let's say, 40 cents and bought the 40 for 10 cents, well, I'm still getting a 30-cent premium. That's not a lot. I probably want more than a 40-cent or 50-cent premium on a 5-point spread. However, I'd still be looking about an 8 or 9% return on that, but I only have to put up 5 points, not 50 points. Cash secured put versus a bull put credit spread. But in that case, I'd be increasing my probability to 75. When I generally do a naked put, it is because I have the goal of owning the stock at a discount. If it does expire worthless, that's great, but I'm not planning on just looking for the put that has the highest probability and the furthest range out of the money to generate a premium and hope it expires worthless. I'm actually selling one closer to at the money. If this had if I was interested, David, in owning Viacom at maybe a decent price of around, let's say, 51 or maybe $50. 50 is a good range, maybe. But I might look at the 52.50, and if it's at $1.50 or $2, probably not, it's too high. But if there's a 52.50, I might sell the right at the money 52.50 put, because hey, if the stock pulls back and is trading just below it, I get the stock at $50.50 or $51 because of the premium I received. I might be okay with that. All right. Now, true, if the stock falls and goes down below 50 and I get it at a cost basis of 49.10, I'd be happier if I expect to stay in it longer term. But I really don't use the naked put strategy as a way to hope just everything expires worthless and I just keep the premium. Okay? I do that with bull puts. If I think a stock is neutral to bullish, I like the premium, I typically enter it as a bull put if I don't want to own the stock, knowing full well that just by entering a spread position, doing a bull put credit spread does not change the obligation of whatever put I sell. And even though I'm in a bull put, I may still have the obligation to potentially be forced to buy those shares of stock at any time. I have to keep that in mind. All right. So to Siva's question, he wants to know, how can I roll? What is the best way to evaluate or to roll a covered call? I have a position on INFN. All right, let's build this on the custom spread tool. INFN. Don't know this stock. Add stock, and I don't know your cost base, but let me just put in 100 shares around, let's see, you sold the 17 strikes. Let's put in 1685, close to where you sold the call. All right, and you have a January 15th, 2016 17 call sold on $1.90. And this was done on October 14th, okay? Now, as we all can see, we saw the stock price a second ago. Stock is gapped up to 21.65. Right? So we're now 4 points in the money. Your potential return if you're assigned is 13.7% of what you invested. Again, sorry, Siva, I do not know your cost basis. I'm estimating a cost basis of 16.85, which is kind of at the money on the position. Okay. However, if this was my position, what are my choices? I could get assigned, earn 13.7%, which was probably within my goals at the time. However, that is 4 points below the current stock price. What are my opportunities for rolling? Well, let's make it easy. Let's add it to the portfolio on Power Options. So I'm just going to click it here to add to the portfolio. And yeah, let's put it into new covered calls for November. Let's go ahead and insert that. Just a webinar portfolio. The system knows I want to buy 100 shares. We're going to treat this as paper trades. I'm going to keep that cost basis at $16.85. Let me go ahead and submit that. Anytime you're tracking a position in the portfolio tool, now see here that CalMaine would have expired worthless. My Expedia call would have been assigned. It's a 115 call. The stock ended at 126. And there's Inferno, of course. And hey, St. Maryland, one that we opened on 11/4 during one of these webinars, looks like it tanked severely. And we're going to get hurt on that covered call. By the way, this wasn't a real trade. Many of you know I don't trade covered calls anymore. I only trade standard collars and married puts and potentially a cash secured naked put. But very rarely do I do covered calls anymore because of too many reasons like this. Stock just gaps down, gets crushed, looking at a 17% loss and probably only countered it by 3 or 4%. So now it's going to take me about 6 months, 5 months to manage that position to get back to break even. In any case, when I'm tracking the position in the portfolio, quick way to view is we can go to position actions and then position analysis. It has to be entered in the portfolio to see the analysis view. This gives me just a breakdown of my current position, where we saw before, only about 1.2% time value and price. We do have 56 days remaining to expiration. If I liquidate right now, I'd have a return of 12% because the time value, so I have to pay back into the call. This 13.7% at expiration assumes assignment when all the time value has decayed out. So we're missing about 1.7% of time premium. Now, the tool does show me potential rollout opportunities for this position. And what it's attempting to do is find positions that actually increase the original expected return at expiration, 13.7%, to a reasonable value. And the only way it found to do that, by reasonable I mean maybe more than 1.5 or 2% increase in the potential percent return if assigned. The only ones it found were out to April. So we could buy back our call today for $4.90. So that's going to be a loss of $3 essentially on the call premium. And then to maybe roll for a credit, we could go up to the April 20 call and receive a credit of $3.30. See, it shows us here that our adjusted net credit, if I buy to close my existing call, that's going to change. Let me clear up the view here. There we go, folks. Let's roll down here to some of these rollout opportunities that we see. And these exist when you're tracking any position, a naked put. You might see them in bull put or bear call credit spreads. The rollout opportunities in the portfolio. So the reason I'm choosing the April 20 is it gives us an increase of a $3 higher payout, and we still have a positive net credit. Because when we sold at $190, we have to buy back at $4.90, so we're down 3. But we can get $3.30 right now for the 20 strike call for April. So this increases my return from 13.7% if I get assigned at January to 20.8% if the stock stays above 20 to April expiration. So it's another 7.1% increase. Now, is that worth it? That's something you have to ask yourself. If you get assigned in January, which is what, 58, 59 days away? Let's just say 60 days away. If you get assigned in January, 60 days away, you'd have 13.7%. You're increasing the potential payout by 7.1% from 13.7 to 20.8, assuming INFN stays above $20. But that's for an additional 85 or 87 days of time. So before you roll for the sake of rolling, just because we see an increase of 7.1%, by buying back our January 17 call and rolling to the April 20 call, we're rolling for a small credit. We're not paying a debit. See, if you go up to the April 22, which has a higher return, you'd have to pay a debit. And that might be okay based on your expectation for the stock going forward. But one of the things we have to ask ourselves is what we're really doing is moving this 7.1% from what we'd see in January to April, which is 85 days from January. So I have to ask myself, does this match my goals? Let's call it 3 months. A 7% return over a 3-month period is really coming down to about a 2.3, 2.4% yield per month. Okay, we're increasing that by about 2.3, 2.4% per 30 days. that, by the way, does match my goals, my expectations, and what I look for with these types of strategies: standard collars, cash secured naked puts, anything above maybe 1.3%, 1.4% for a 20-day trade is probably within a reasonable range. So this is an increase of 2.3% for the next 90 days. I'm sorry, increase of 7% for the next 90 days, or an extension of 90 days close to it of what I would have. So that's pretty close to what I'd want to see. But you want to make sure that you're not rolling for the sake of rolling. In other words, if this was only going from 13.7% to 15.1%, let's say a 1.4% gain for a 30-day trade, because I'm so deep in the money now, I'm sorry, for a 90 days extra, this does not match my trading goals. I wouldn't do that roll. I'd rather let myself be assigned and take the return. Okay. Now, what are you really doing here? An easier way to look at this, if you choose one of these options here, is as you look at the rollout opportunities from the portfolio, you can select Simulate Trade, and this will give you a side-by-side comparison of your position. Your original position is on the left again in red, just more graphical. We know we'd probably be assigned here with the stock trading at 21.65. We'd make 13.7% over the next over the next 60 days. Is that how far? Yeah. Now, if we do make an adjustment, and I'm going to show you a different adjustment there, Steve, in just a second. Well, not a different adjustment, but a different tool to use. Here we've rolled up to the April 20. We had to roll out here. We still roll for a credit, but now we're looking at that 345 or 20.8%. That increase of 7.1% for an additional close to 90 days of time. Okay, so we moved from 205 to 345, but now we're way out to April. And if the stock gaps again and goes up to 30, well, we may have to put more money into the position to roll it at that time. Let's go back to the portfolio for Infinera, excuse me. Let's go to the profit and loss chart again. Now, when we looked at the rollout opportunities, we only saw April adjustments. The stocks gapped up to 21.65. Why didn't we see an opportunity of buying to close to January 17 and rolling up to the 20? Well, we can come back to the profit and loss chart here and see that manually. So let's go to January. My 17 call's already been added, but I'm going to add it one more time. I can click it again, and it appears here. So I added the 17 call to the next line of my custom spread tool. And I did see that the bid ask was 470 to 490, so I'm putting it in at 480. Now, of course, if I just simulate this, it's not actually simulating that I'm buying to close the option. What this system is reading is that we own 100 shares of stock. We're short a January 17 call at 190, and we bought a January 17 call at 480. Well, that gives us the exact simulation we want. The system's just not reading it that we've closed it. So my new cost basis for just the stock would be $19.75 on this position. Okay, with the stock now trading at 21.65. Jot that down. 100 shares, new cost basis after close is $19.75 per share. Okay, but what we wanted to show here for Steva is go to January now, and let's go to the 21. Let's say slightly in the money, 160 to 170. So let's go ahead and sell the January 21 call at 165. Okay, so you could still increase your return. Remember, we had a return of 13.7% return, okay? By rolling up to the 21 strike, but paying a debit, remember, because we had to buy this back at 480. We took in 165 plus 190, which is positive premium of 355. We're paying out 480, so we're essentially short $1.25. Okay, we added a debit of $1.25 in the position, but that's in order to try to get 4 more points on the strikes from 17 to 21. So we're down $1.25 in option premium. We paid an extra debit, but we're trying to get assigned at 4 points higher. But this only increases our return by 2.3%. Okay, from 13.7, where we'd be at January expiration if we probably did nothing, and it stayed above $17 per share. Okay, stayed above 17. Oh, my apologies, folks. $17 per share is here. Okay, there's 17. So if it stays above 17, we get assigned and make our 13%. So be looking at something like this here. So by rolling up and staying in the same month, you're increasing it by 2.3% up to 16. Okay, so what you really want to ask yourself is, does this still match your goals? It probably does. If you'd be happy with 13.7, you're going to be happy with 16. You could stay in the same January expiration time frame and have a reasonable adjustment. If you wanted to shoot for more, remember you could go out to April. All of that being said, Siva, I think you're in a good position right now if I saw that correctly. And let me take a look here. I think it just jumped right from January to April. Okay, good. The reason why I say you're in a good position is come Monday or Tuesday, if you haven't adjusted this position yet, you're going to see some other opportunities. So after the November options clear out, you're probably going to see at least a February. Depending on the cycle, you may see a February or a March. So you may have a better opportunity. You may see some better returns you like by buying to close your January instead of just moving up into January, moving up into February, which would only be maybe 84 or 85 days out instead of April, which is 147. So Siva, I checked that Monday. That's when those new series are going to come out after the Novembers are canceled out. You'll probably have at least the February. I'm assuming you may have the March, but just by the setup here, you think you're going to have a February in there. You may also see a June or an August come out as well. Something in between April and January, as well as between January and April. So you'll have some more opportunities to evaluate adjustments in that scenario. But yeah, if you're using power options, I would plug that into the system. I'd plug that into the portfolio and then evaluate your rollout opportunities on Monday, see what new expiration cycle comes out. All right. When Mike says, I should have looked at this before while we were there, but we're here now. Mike wants to know, when writing covered calls against the stock portfolio, if the underlying gaps up in the money, should you roll up to keep the stock? Okay, we kind of touched on this, but I want to address his questions directly. The realized loss is balanced by an unrealized gain in the stock. Yes, but I've seen a stock cycle giving back the unrealized gains, resulting in losses. What is the best way to handle the gap in the money? Let me show Siva something else. And Mike, I know that you've heard this before and you might be tired of it. Many of you know I trade the radioactive techniques. What was Siva's original position? Well, this is assuming my cost base is $16.85. Had a stock at $16.85, got a fantastic premium for the 17 call at $190. The stock shot up due to some event, earnings, buyout rumors, FDA approval. It's now trading at $21.65. Okay. If I buy to close my call now with the listed price of $480, what am I left with? I'm left with a cost basis on my stock of $19.75 per share. Okay. Now, does it make sense to roll the call, Mike? Again, you'd want to look at the numbers, but you're absolutely right. Did what I just show, could that get Siva in trouble? Yes, it could. Because remember what happens. I increased my cost basis to $19.75. If I rolled up, I'll go here first again. If I rolled up the January 21 call at $1.65, remember the initial cost basis was $16.85. It was about $14.90, okay? So if I roll up this call, I've got $16.85 in the position, right? I've got more money in the position. If the stock pulls back now and drops back down to $16, $16.50, $15, I can risk losing more than if I just let myself be assigned. That is a problem, especially with a large gap. This is a reasonable gap percentage-wise, but we've seen $80 stocks jump 30% from earnings. You know, we've seen them go up almost to $110 on those positions. For example, let's take a different view. Completely synthetic trade or fake trade. Okay, let's say I got Facebook, 100 shares, $85 per share. And at one point, I sold today's 80. Let's say, what did I say? I bought it at 85. Yeah, let's say we sold the at the money 85 at the time 3-4 weeks ago for $1.50. I know this isn't what happened with Facebook, but let's say it did. Okay, now the stock's gapped up. It's trading at 107.32. Well, that's not good. I would have done this with only about a 2 or 3% return. So let's put in $2.50 for this premium. Fantastic, 3% even. Okay, good numbers, right? Now the stock's up at 107. Does it really make sense? Of course, I'm at a November expiration. Does it make sense for me to pay $22 per contract roughly, to $25, I think, $22, my fault, $22.50 or so to buy to close this call and sell the 107? This one's where your issue comes into play. Or not your issue, but your comment might comes into play. By the 85 call back now, let's just call it some time value at 22. And Siva, I'll go back to your position in just a moment. I want to show you something else. I buy this back at 22.20. I now have 104.70 invested in the position. Okay, 104. This is my cost per share after this adjustment, after I buy to close it. Well, the stock's at 107, so I have a $3 profit. 250, but I've got close to a $3 profit, and now I could sell the 107, the 108, and continue the trade. Is it worth it? Only if it matches your goals. What's the risk? Exactly that. What happens now if Facebook drops back down to 100 or to 90? Even if I sell the 105 call now for, let's say, December or 2 weeks out in time, let's go 2 weeks out to the 10. Oh, nice premium. Let's stick with that 107, about 219. Okay. And I'm going to clean this up a little bit. We know that after the roll, we already saw it, that our cost basis would be 104.70. So I'm going to take out those other two calls, put this at 104.70. Remember, my original return was 3%. I only gained 1.4%, but I also am just using a 2-week out option. Okay. But where's my exposure? My exposure is now 1025, when originally it was only 8,300. Now it's 10,251. Okay. So what if now the stock's at 104.70? I said to myself, okay, well, maybe I'll go out a few months. Let me go out to March. And let me look at the 115. Now my cost basis is 104.70. The stock's up to 105. I could buy this 115 put for $11.95. Looks expensive. Probably it is a little expensive. But now I've only got a risk of 1.4%. So I'm guaranteed now to get 11,500. Yes, I paid more into the position, but to guarantee 115 back, and I'd only paid 104.70 to begin with, so my total cost in is 11,665. So sometimes when you're rolling for a profit, depending on the price, if you're worried about a pullback, you might want to add the put. Oh, and by the way, let me go to standard December expiration now. That's not great. But if I get that 115 call now, I'm using that because it's equal to the put strike price. But if I sell that for 60 cents, I've got some high upside. I can't lose more than $114 or 1% on the position, and I can make 5%, of course. Remember, our original return was 3%, so come December, I still could make 5 as the maximum. But even if the stock goes back to $90 or $80 per share, I'm not losing 20 points. I'm only losing 114 in the absolute worst case scenario. So in the situation where you're evaluating rolling a covered call up that's really gapped up against you, remember that once you pay that intrinsic value back, you're increasing your cost basis, but you took in another premium, and the stock is probably trading above that. You've got some unrealized profit still once you buy to close the short call, which, by the way, capped most of your gain, of course. So you could evaluate potentially buying a put so that if that reverse does happen, Mike, you guarantee that you can't lose more than 3 or 4%. And if you wanted to go shorter term, you could do that also. Okay? All right, and that's one thing you might want to consider as well. Okay, I just wanted to, okay, so let's go back to Siva's position with my numbers, which I don't think are his. I apologize. And that was INFN. And I'm going to put in 100 and more shares of stock at $16.85. And we had sold our call at 190. It was far out. January 17 call at 190. Okay, so there's our 13.7% potential return on our covered call, who could be assigned. A secondary thought on this one, if you're concerned about a pullback, before you roll the position, if you're concerned about a pullback, you may just want to leave it alone. Remember, we looked at the position analysis for this covered call position. I still have not much, but 1.2% of time premium. If I leave this open for another 20 days, I'll easily get half of that back, right? So my time value will drop down to 0.6% or so, likely, very likely. That's not where we're going to be. Okay, now let's buy back the January at 490. 480, midpoint. Where did that leave us? That left us with a theoretical stock ownership at 1975, and the stock is trading at 2165. Okay, so let's change this. After I close the call, I'd have a cost basis on INFN at 2165. These are my numbers. And let me look at April, but instead of selling the April call, maybe do both. Buy that 22 put, 255 to 270. Let's call it 265 midpoint. Yeah, it's kind of ugly, isn't it? So this is a 9.5% loss. Didn't really do as well as that Facebook position that was really deep in the money. But I don't know. Can I get some of that back? Well, I can get about 70 cents back. I think this is too much, though. Siva, I wouldn't advise doing it with this April put as I just showed. I don't think that's giving you enough protection. It's still too high of a risk if it removes it. And yeah, I don't like that. You might be better off using a cheaper put than a radioactive trade. Instead of using an in-the-money put that's far out, you're buying back your January. You might still look at April, but again, you get what you pay for. So if I only bought an April, no, oh, it didn't do it right. Oh, my apologies, folks. That did not do what I wanted. Let me look at these numbers again. The 22 put at 2.75, no, 2.65. It used the, I accidentally put in the current cost basis, I think, not 1975. That did not give me the numbers I wanted for a reason. It wasn't the right numbers. There we go. Okay, Siva, this is looking better. After you buy to close the call, remember 1685 minus the $1.90 plus the $4.90, your cost per share was 1975, roughly around that. If I bought the April 22 put for 265, I have a new cost basis of $2,240, but I'm guaranteed to get $2,200 back, so my max risk is $40 or 1.8%. Rather than just rolling the covered call and worrying about pullback, I could pay some money now to lock in a small risk of only 1.8% and still have some upside. Oh, and by the way, what we looked at before, how about now I sell that 22 call for 70 cents if I think, only if I think the stock's going to stagnate and hang around this price for the next 30 days. What are you left with? You're left with a position that cannot lose, still could make 11.6% at December expiration. But remember, this put that you just bought is all the way out to April. You still have 147 days. So at December, whether you have to adjust this call or it expires, you could then sell a new January call, a new February call, and so forth, knowing you have no risk on your position and trying to increase this return going forward. By the way, with the April put in place now, there's nothing to say you can't sell the January call against it too for a little bit higher. Not much. It's not double. So I'd probably stick with the December in that scenario. But I could go to 115. Sell the 22 call at 115. Guaranteed a profit of 3.4%. Even if the stock drops to $2 per share, you're guaranteed 3.7. And at January expiration, you're at 12.7%. Less than you would have received originally by 1%. But look, the stock can do whatever it wants, and you're guaranteed a profit of 3.4%. That's another idea that instead of just rolling the call, now that you have some unrealized gain in the stock, you could roll that. Michael says, didn't the INFN cost you $19.95? The original price I used was $16.85, and we sold the 17 at the money call for $1.90. And then buying it back, Michael, for $4.90, put my new cost basis on the stock at the 1975 we're seeing here. So that's including the original roll. And now what I did is converted it to a married put and then converted it to a short-term collar where I have no chance of loss. And yeah, I took away the return I might make if I just left the covered call open and it stayed above 17. We'd make 13.7%. But now at 22, I can continue to manage the position and I'm guaranteed a profit even if the stock pulls back to $2 per share or $1 per share. That's some of the advantage of considering an alternative idea. Rather than just rolling the call, there is some unrealized gain you might have based on the original premium you received and the buyback cost of your option. You can harness some of that unrealized gain by buying an in-the-money, slightly in-the-money put, even far out in time, to give you a really low risk on the position and still be able to generate premium against it and a bulletproof status. So this one actually looks better than the Facebook one. So take a look at some of those numbers, especially when those new series come out on Monday for the February and March series. And if you have questions about some of the analysis you're doing, give me a call next week during market hours. Of course, I'll be there in the office. All right. And Mike, that really applies to you too. You know, the evaluation, does it make sense for me to roll something that's so deep in the money? It might, but remember, if you're just planning on rolling a covered call that gapped against you, if you're going 2 to 3 months out because you're trying to roll for a credit, to make sure you're rolling for a credit, not paying a debit for the roll, make sure that the increase in premium matches your trading goals. You originally started your covered call trade with the goal of maybe making 1.5 to 2 to 2.5% or more per month, okay? Well, now, in that scenario, if your roll that you're going out to, let's say 30 days or 60 days, if the roll doesn't match that, if you're only rolling from, say, 8% yield to a 9% yield for a 60-day trade, if it doesn't match your trading goals, don't trade against yourself. Maybe just let it get assigned and then look for other opportunities as well. Okay. David, I have a watch list of stocks I wouldn't mind owning. I seem to get assigned far more often than than the probability would indicate. Okay, one thing I didn't add, okay, and I didn't mention this just because it's, you know, I wasn't trying to hide anything. That's not what I'm trying to get at here. No, Calmaine again. I didn't really address this too much when we talked earlier about the probability. I probably should have, but I didn't. So let's go back to December. We talked about the probability. We talked about the range of the ATM bell curve, not the ATM bell curve, I'm sorry. The standard deviation bell curve that allows us to evaluate, okay, based on where the stock has been, what is the likelihood it's going to be at or above this price in the next 30 to 60 days. You know, 2 strikes in the money 30 days out and 88% probability is actually kind of high. But I know it's high because I have not, as I mentioned, I've been in Calmaine for almost 4.5 months. I've never seen it drop below 50 that I can remember. And if it did it just for a day or so, okay? So it's a very high probability stock's going to stay below 50. Based on what has happened in the past 12 months, the past 52-week trading range, is that necessarily an indication of what we're going to see going forward? No. Is it an indication of any black swan or unexpected events in the near future? No, it is not. I don't want to put the idea, I'm not trying to be the media and try to, you know, live off fear or make you live off fear or anything along those lines, but let's be honest. If something does happen this weekend here in the United States related to anything that we've seen in Mali, Paris, anywhere else, Beirut, for example, let's be honest, Monday morning, the market's going to take a severe hit. If we see any kind of activity in any of the major cities in the U.S. that are related to any kind of terrorism, we're going to see a pullback. This stock, Calmaine, might drop below $50 per share, even though you had an 88% probability, because that's not factoring in any kind of black swan event. Calmaine could come out over the weekend and say, oh, you know what, we fudged all our numbers for the past 6 quarters. Sorry, the stock drops down to $30 per share. You can't see that in the probability equation. It can't be accounted for. This is one of the reasons why I trade only now with standard collars and married puts when I'm buying stock. I still do calendar spreads a little bit. I still do credit spreads, but I don't do covered calls, and I rarely do cash secured naked puts unless I really like the stock, because of that potential that this stock could open up at $45 on Monday, depending on what happened over the weekend that I didn't have control. Let me just show you Calmaine for a minute here. I didn't save my settings. I might reset them. Let me go into big charts here. I really like this stock. I had a lot of fun with it. Oh no, here it did. Yeah, back in August and September, around August 24th. That's the only time I saw it drop below 50. Remember that? Market was declining, August 21st through 24th, bam. And then it's right back to where it was 2 weeks later, okay? That was an unexpected event. Nothing in them, I mean, sure, we were falling, this stock was falling, but this decline, that random decline on August 21st to August 24th related to other geopolitical events, oil, things of that nature, every stock had this sort of tank down here. It actually dropped below 45. I had a 55 put in place, so I didn't care at that point. But again, those are some of the things that can happen, those unexpected events. Throw all probability out the window. I would have sworn that Calmaine was not likely to drop below 50, but then it happened on August 24th, okay? That decline that we saw, that whole day or 2-day decline that we saw, that's when it happened. 2 weeks later, it's right back to where it was a week before. a week later almost, 10 days later, it was back exactly where it was 10 days before when it started that decline, and most stocks were. Okay, so I lied to you. It did drop below 50. I do remember that, but it was just that one event. Here, I know this is bad, but at the beginning of August, if I went to sell that 50 put we were talking about, Mike, on CalMain, do I have it? 11, oh, we have it. I'm on a trial account. I'm not on my real account here, but I think I have this. Let's go back to the chain for CalMain. Come on. Oh, it's only going back to September. Okay, let's do this. Should go back 3 months. I guess it's only going back to. I'm going to pause my screen for a second, folks. Let me look at something. I'll log in. Oh, I'll close these out too. I'll close some windows here. Let me log on to my other account. All right, let's go to CalMain's chain. You're not supposed to be, I'm sorry, someone said I don't see you doing anything. You're not supposed to be seeing me doing anything right now. I'm just logged into my personal account there. So let's go to chain. Let's go to calls only. Doesn't matter. I'm going to go back to August 1st for CalMain. Okay, August 3rd, beginning of August. Let's go back historically. And let's talk about this, Mike. Remember, August 24th, it was after expiration. So let's look at September. Back on August 3rd, CalMain was at 55.11. Sorry, Mike. You're absolutely right. We want to look at puts. All right. 50 strike put. Not as high as I would have thought, but okay. The 50 strike put on August 3rd, good bid, 95 to $1.30 for about 2 strikes out. 1.8%, 2% yield. But that's for 46 days. We're just doing September for a reason. We've got a good 75% probability above. Okay. Let's go to August 24th. What happens 21 days later? Stock's at 47.50, right, because of that event. And what happened now at this time? Here's my 50 strike put, 420 to 530, so I'm down about 380. And of course, the probability adjusted, the new probability above. Oh, that's not, I'm sorry, I'm looking at October. Let's change it. We need September. My apologies. Fantastic. There we go. So, August 3rd, we had a 75% probability that CalMain would be above 50. The unexpected event, the unexpected market pullback on August 24th, the 50 put we may have received $1.10 for is now at about 350 to 430 cents. So okay, 390. So we're pretty much close to losing $2.10 or $2.80, $2.60 or so. Right? And the probability is adjusted to only 35.9% now that the position would be trading above 50 at September expiration. Where are we on September 16th, 17th, the day before expiration? 57.49, where there's a 99.9% chance. Okay, the illustration here is that the market is ever changing. The probability is really based on where we've seen in the past and what we've seen happen in the past as well. In the case of this, if I had gone into CalMain and I had sold the 50 put for August expiration, which happened before that decline, it would have expired worthless. And if at that time I said, oh, the September series looks really good, I'm going to sell the 50 again because it still has a high probability, and then August 24th happened, I now probably would have bought to close the 50 put, rolled down to the 45, and the stock ended up at 57.50 anyway. It's a hard gauge. The probability, just like delta, is ever changing. It changes with the market dynamics. It's the best equation or model that we can use, but it's only under the assumption that everything that has happened in the market has stayed the same or stays the same in the next 30 to 60 days. And as we know as options investors, we know that's not the case. Mike, I apologize. You had sent in another question. I didn't see what it was within the last maybe 20 minutes or so, and it accidentally got deleted. I was kind of just answering David's question here regarding to the he gets assigned more often even when he uses the probability. And that's the reason why, is because unexpected events happen, earnings events. That's why I try to avoid certain things like bull put credits, bear call credits, or maybe even cash secured naked puts if I have earnings coming up between now and the expiration date. As well. But the probability, of course, ever changing, unfortunately. There's no guarantee. But for those of you doing credit spreads, this is just one of the reasons why Ernie and I recommend that if you're trading bull puts and bear calls or iron condors, you may be better off trading them only on broad-based ETFs and indexes. Yes, if a black swan event happens market-wide, knock on wood, nothing happens here over the weekend in relation to what we've been seeing happen around the world in Paris, Beirut, and in Mali last evening as well. But if something happens here, I don't know, maybe a 5% decrease across the indexes, SPX, NDX, DXL, 4.5%, that's tough, and it's going to affect the stocks more. The stocks are probably going to drop 8, 10, 12%, whereas the indexes themselves might drop 5%. Can't control that. We can't control the unexpected. But what are we spared usually with the indexes by trading the leverage credit spreads, debit spreads, and iron condors on the broad-based indexes and ETFs from stocks? Nothing about a boardroom scandal, nothing about change in boardroom members, nothing about incorrect reporting of numbers, nothing about the stock you selected being the strongest in the sector, but then the whole sector becomes weak. Okay, yeah, if the S&P 500 became weak, sure, the SPX or the SPY would decline in price. But to pull everything down that much, it would have to be across all sectors. Okay, and so that's kind of the thing. I'm not saying you should do covered calls on just the ETFs. I'm not saying you should do naked puts on just the ETFs. What I'm saying is that the leverage spread trades that come with that 10-to-1, 12-to-1 risk-reward ratio may get you into trouble. That's why we recommend doing those credit spreads and debit spreads, iron condors, on the ETFs and indexes as opposed to standard stocks. Siva followed up, where will I get a recording of this? Okay, at any time, you can access our free webinars. So if you're on Power Options, if you logged into your trial, you can go to Home and then Free Webinars, and there's a different series, different categories, my apologies, of recorded webinars. Power Options Tools, Option Strategies, things like managing your long options positions, managing your naked put positions, what is a vertical spread, managing your spread position as well, managing your naked puts, I said. Options concepts, exercise versus assignment, manage your broken stock, weekly options, implied volatility, Greeks, and so forth. And then here, Siva, is where I typically throw the Friday presentation. Now, I know the last one's on 10/16. It's because the past few Fridays we've actually gone to about 6 o'clock, and we're only at 5:40 now. We've gone about 6 o'clock, so the webinar didn't convert until 7:30. By then, I'm putting the 2-year-old, or getting the 2-year-old ready for bed, which any of you have children, you know that putting a 2-year-old to bed might start at 7:30, doesn't end at 10:30, and then the weekend happens. So I've got the last week's presentation archive, or recorded, the one previous to that. So I'm probably going to upload 3 or 4 webinars this weekend. Today's, the one from last week, and the one from the previous week. So we missed the 30th, but I might still have that one. But then, around November 7th, the 14th, and today's the 20th, or the 13th, I should say. Okay, but at any time, anyone can access these presentations. You don't have to be logged on to your Power Options account. I just sent everyone a link in the chat window. Just go to powerop.com/webinars.asp up here at the top. That'll give you access to this public page, and then you'll see this one probably here tomorrow sometime, maybe later this evening. I can't give you a guaranteed time. I'd like to say in the next 2 hours, but it might be in the next 4 hours, but it'll definitely probably be there sometime tomorrow. So you'll just see them by date, but I'll have a full description of what we discussed. Okay, I'll have a smaller version of what we discussed today as well. Okay, so that'll be available for you guys at any time. Just go to powerop.com/webinars.asp, and you can take a look at the entire archives for just the Power Options tools, various option strategies, different options concepts, and then our requested topics are always the Friday discussions, because it's your requested topics that you wanted to know about today. All right. Well, ladies and gentlemen, I don't see any other questions coming in. I will encourage you, if you have any last-minute questions that you can think of right now, why don't you go ahead and send those in. It's only 5:40 right now. We can spend another 5 minutes or so here if anyone has a last-minute question. I just want to remind everyone, if you haven't yet, just remember, go to powerop.com, the main homepage there, www.powerop.com. And if you haven't done so yet, you'll see the free trial information on the right-hand side. Just put in your name and email address and register. You'll have 14 days to test out our service. After that, of course, we are a subscription-based service. So you can have full access to the power options tools with 20-minute delayed quotes, really about 15 or 16-minute delayed, and that's $60 per month. And of course, those historical tools I showed you, we're able to go back all the way to April of 2006 to view options, chains, or run searches, see what would have matched your criteria. The 20-minute delayed plus the historical service is $100 per month. And of course, we do offer a real-time service. Every time you refresh the page, you're getting the numbers and calculations at that very instant, and that's $100. And the real-time plus historical is $140 as well. Upcoming next week, I know Kurt's doing a webinar on Tuesday. Since it's a shortened week, I have not decided if I'm going to be doing a webinar on Wednesday. I may try to force one in on Monday so we can get a webinar in next week. Most people are going to start leaving Wednesday afternoon, Wednesday evening, so I don't want to necessarily ruin that there. Friday I will not be available, of course. I will be out of town, so there will not be an open discussion presentation next Friday, but we will have one on December 4th following the Thanksgiving weekend as well. So there will be at least one radioactive trading presentation next week, likely a power options presentation. We will let you know by email when that is available. Now next week, if you think of any questions, just remember, send us an email at any time to support@powerop.com. You can also call us toll-free if you live inside the U.S. at 877-992-7971, or you can reach us at 302-992-7971 if you live outside the continental U.S. The coaching session, Siva, is free, okay? I'm sorry, folks. Let me go here. For Power Options trial members and subscribers, when you go into home and click on free coaching, it'll give you a schedule, and you can just set up the time. I'm sorry, I'm just going to show you right now. Some of these are not available. I turned off mine. I don't think Ernie turned off his. I don't think Ernie or I are available Thursday, of course, or Friday. We should be available Monday, and we might be some sessions Tuesday. What you can do also is if you wanted to schedule a coaching session but you don't see a time that matches your schedule, email in or give us a call during market hours, and we'll try to set something up for you, see if one of us can be available, okay? Chuck is a trial client. Where do I see the Tuesday webinar? Do you mean the one that happened last Tuesday? Chuck, I'm sorry. The one that happened last Tuesday or one that's upcoming this Tuesday? Oh, this next week. What's coming up next week? Okay. It's not on power options. The Tuesday presentation is for radioactive trading, okay? So to register for Kurt's webinar related to the radioactive trading techniques, oops, 1 second, folks. Wow. Okay, sorry about that. GoToMeeting is doing some strange, fun things today. Little glitches and little indications keep popping up on me here, and it doesn't look like anything's going wrong, but they're notifying me about all these little things happening. Okay, so Chuck, my apologies. If you go to radioactivetrading.com, the registration for the webinar is there because it's Kurt's webinar for radioactive trading, bulletproofing 101, why you should stop using stop losses. Just click register now, and hey, why not? I don't know how this is going to come through, but I'll send this link to you in the chat window. It's going to be it's not as big as I thought. There you go. So to register for Tuesday's 12 noon Eastern Time webinar with Kurt about the radioactive trading techniques, some of the things we showed Siva today where he could actually bulletproof his covered call that's deep in the money and he's looking to roll it, so he has no risk now on the downside. But there are other things that are going to be discussed in relation to that. Just use that link I sent you in the chat window. Just go to radioactivetrading.com, scroll down and click register now. That'll get you set up for the webinar on Tuesday. And Kurt hosts these every Tuesday and Thursday at 12 noon Eastern Time, except for next Thursday because it's Thanksgiving. He won't be there. But at any time, you can check radioactivetrading.com and see what webinars are coming up for Kurt. And, of course, at Power Options, you'll always see our next webinar usually up at the top of the screen when the next webinar is coming, right here in the pod, actually, the upcoming live webinars pod here. But if you go again to the free webinar section, you'll have that link to watch live webinars to register for those as well. All right. Okay, once again, ladies and gentlemen, I want to thank you for joining me today. I hope everyone has a fantastic weekend. Hopefully we'll see you next week at one of our other live presentations. Remember, any questions that you have, send me an email or give me a call. I'd love to talk to you and love to hear from you. Have a fantastic weekend, everyone. Hope you have a great, safe weekend, and of course you stay warm depending on what part of the country you're in. And we'll see you all again soon. Take care, everyone. Good night.